Assalamu alaikum. We discussed the bonds and now we will discuss the features or characteristic of the bonds. The types of the bonds we will discuss in our upcoming classes because we have a separate chapter on it. So features of the bond or characteristic of the bond. Most bonds shares some common basic characteristic. So these are face value, coupon rate, coupon date, maturity date and issue price. Face value, or this is also called par value, that is the money amount the bond will be worth at maturity. It is also the reference amount the bond issuer used when calculating interest payments. Keep in mind that when like 5% interest on a bond, so 5% should be calculated on which price? On market price? No. Interest, keep in mind, will always be calculated on the face value. So when corporation issued the bond, so they must have the face value. For example, say an investor purchased a bond at a premium price 1090. It means more than the face value. Premium price means more than face value. Another investor buy the same bond later when it is trading at the discount rate 980. Look at first the market price was 1090. Now the market price of the bond decreased to 980. So 1090 and 980. When the bond matures, both investor will receive the 1000 face value of the bond. Means that, look at now, this 1000 is called face value. So face value means the value which is written on the bond and on which the interest is calculating. Such value is called face value of the bond. When bond that is sold out in the market more than face value, that price is called premium price. And when the bond that is sold out in the market lower face value, so that is called discount price. Simple, if the bond face value is 1000 and now in the market that is sold out on 1100, so this is called premium price. When the face value of the bond is 1000 and it is sold out in the market on 900, this is called discount price. So face value is of the bond is one of the features or characteristic. The bond must have the face value. And on the basis of that face value, interest or coupon that should be calculated. Number second, coupon rate or interest rate. So coupon rate or interest rate is the rate of interest the bond issuer will pay on the face value of the bond expressed as a percentage. The rate of interest of the bond issuer pay to bond holders on the face value of the bond. An interest rate or coupon rate will always be expressed in percentage form. For example, if the bond face value is 1000 with 10% interest, or coupon rate. So it means that the bond holders will receive 10% of 1,000. 10% of 1,000 means $100 coupon per year. And the bond issuer or corporation will pay this amount. So the rate, interest rate or coupon rate is that rate which should be expressed in percentage form and will be calculated on the face value of the bond paid by corporations to bond holders. Next one, coupon date. Coupon rate will be, look it, that should be specified in the bond. And coupon date will also be written on the bond. What is coupon date? Coupon dates are the date on which the bond issuer will make interest payments to bondholder. Look at, I issued a bond to you of 1,000 face value. Clear? And I sold out this bond on discount to you on 900. I took $900 from you and gave the 1,000 face value bond. On this bond, the coupon date is, let's suppose 31st of December is written. So on every 31st December till maturity, I will pay 10% interest. So 10% of 1,000 is equal to 100. So that date at which the issuer of bond will pay interest to bond holder, that is called coupon date. The date at which the bond issuer will make interest payments to bond holder. Payments can be made in any interval, maybe monthly, maybe quarterly, maybe semi-annually, or maybe annually. But the standards is semi-annual payments. The next one, features or characteristic of the bond, that bond have the maturity date. What does it mean by maturity date? Maturity date is the date on which the bond will mature, and the bond issuer will pay the principal amount or the face value to bond holders. Look it, I issued the 1,000 face value bond on 900 for 5 years. When 5 years are complete, so I will give you 1,000. Why? The face value is 1,000. We decided that I will redeem back this on face value, not on market price. What will be the market price? Market price may be more than 1,000 or less than 1,000. But as we decided that bond will return on the face value, so I will give you 1,000 back and will take the bond from you. This date is called what's maturity date. Maturity date means that date at which bond is mature, the issuer of the bonds make the face value payments to the bond holders, and bond holders returns back the bond to issuers of the bond, to corporations. So that date is called maturity date. Next one is issue price. Issue price is the price at which the bond issuers originally sells the bond. That price is called issuer issue price. Look at the 1000 face value bond I issued on 900 or 950. So this 950 is called what's issue price. Hope you will understand. Look at two features of the bond: credit quality and the times to maturity are the principles, that is determinants of the bond's coupon rate. If the issuer have a poor credit rating, the risk of default is greater, and these bonds pay more interest. Why? This is risky now. So when bonds are risky, so interest rate will be high. If bonds are risky and interest rate is low, so investor will not make investment. Bonds, they have a very long maturity date, also usually pay a higher interest rate. This higher compensation is because of the bondholder is more exposed to interest rates and inflation risk for an extended period of time, like for the 20 years. So for the 20 years when interest rate is fixed, so as we studied, due to the time value of money, one, and second one due to the inflations. And maybe in the upcoming 20 years, the returns of the bonds and the inflation rate may be equals. So we will get the returns, but that is not profitable for us. Why? Up to date returns, the value of our assets, that is devaluing due to the inflations. So this was the features of the bonds. Our next topic is the difference between primary market and secondary market. Too much easy topic. So primary market, it is a market in which the shares, debentures, bonds and other securities are sold out for the first time for collecting long-term capitals or long-term money. In primary markets, securities are created for the first time for the investors to purchase. New securities are issued in these markets through stock exchange, enabling the government as well as the company to raise the capitals. So, dear students, for a transaction taking place in the markets, there are three entities involved. It includes company, investors and underwriters. A company, they issued the security in the primary market as an initial public offering, IPO, first time. And the sales price of such new issues security is determined by the concerned underwriters. Underwriter is what? These are the third parties, like investment banks. What they do, they give price to these securities and also take the responsibility of sold outing it into the markets. So the price of these determined by the underwriters, which may or may not be a financial institutions. Underwriters may or may not be financial institutions. And underwriters only facilitate and monitors the new issued offering. Investor purchase the newly issued securities in the primary market. Yeah, in which market the investor purchase the newly issued security, that market is called primary market. Such a market is regulated by the Security and Exchange Commission or Security and Exchange Board. So the entity which issues the security may be looking to expand its operations. Like if corporations they are issuing, or if government they are issuing for the first time, so funds will be generated. Primary markets example of security issued included notes, bills, government bonds, corporate bonds, as well as the stock company. So primary market is that a market where newly issued securities are trading. That market is called primary markets. This market is also called new issue markets. The money collected from this market is generally used by the companies to modernize their plants, machinery and building and other business activity, or we can say that for the extension of the business or expansion of the business and for the setting of the new business unit as well as. Features of the primary markets. What are the features of the primary market? So new issue offers. It is related with new issues. The primary market organizes offer a new issue which had not been traded on any other exchange earlier or on any other market earlier. Due to this reason, it is also called new issue market. Organizing new issues offers involve a detailed assessment of the project viability among the other factors. It has various methods of float capitals like public issuance and private placement. So look at the new issues is also distributed in the primary markets. Distribution in the initial stage with a new prospects issues. It invites the publics at a large to buy a new issue and provides detailed information on the company issues and involve underwriters. In a publicly, some securities that are issuing in these markets, and similarly privates, replacements, the placements of the security, issuance of the security also took place. Another one features of the primary markets that secondary markets comes after the primary market when the primary market functions taken place. So then after that the secondary markets oil comes. Public issuance in our second features, public issue is common methods of issuing securities of a company to the public at a large, to common people. It is mainly done via initial public offering, resulting in companies raising funds from the capital markets. These securities are listed in the stock exchange for the trading. A private held company converts into a public trade company when its shares are offered to the public, initially through by IPO. So the private held company will be converted to the public trading companies. Such public offers allow a company to raise funds for the expansion of the business, improving infrastructures of the business, and repaying its debts. Trading in the open markets also increases a company's liquidity and provides a scope of issuing of more shares in raising further capitals for the business. The Security and Exchange Commission, or the Security and Exchange Board, is the regulatory body that monitors the initial public offering. When look at when first time the securities that are issuing, so through by IPOs that are issuing initial public offering. So as per its guidelines, a requisites due inquiry is conducted for a company authenticacy that either company is allowed to issue or not. Who will control it? Security and Exchange Board or Security and Exchange Commissions. And the company is required to mention its necessary details in the prospectus for the public issue. Company have the prospectus, so in that they will completely mention it. Private placement, when a company offers its security to a small group of investors, it is called private placement. In public issuance or public placement, company issued their security to all of peoples, to a large group of peoples, but here in a small group of people. This is called the private placement. Such security may be bonds, stock, or other securities, and the investors can be both individuals or institutions, to a few individuals, to a few institutions. Dear students, private placements are easier to issue than initial public offerings, as the regulatory bodies are significantly less. So it's also incurs reduced cost and time, and the company can remain private, that will not become public. Such issuance is suitable for the startup or companies which are in their early stage. So they need a little bit funds. That's why private placements that should be taken place. The company may place these issuance of the security to an investment bank, or a hedge funds are placed before ultra high net worth individuals. So then these investment banks, they take the responsibility by the selling of the security in the primary markets. Clear? Next one is secondary markets. As its name indicates, secondary market. Secondary markets, a secondary market is a platforms where the shares of the companies are traded among the investors. Or we can say that secondary market is a market where already issued securities like shares, bonds, and all type of security that are trading. It means that investor can freely buy and sell shares without the intervention of any issuing company. In these transactions among the investors, the issuing company does not participate in the income generating, and share valuations is rather based on its performance in the markets. The income in these markets, dear student, is thus generated with the sales of the shares. from one investor to another investors. Look at when in the primary markets the company sold out their securities, so in the secondary markets these securities are trading among the investors. So investors are getting benefits in shape of getting the capital gains. Clear? So company, even though the share prices are increasing or decreasing, in that the company are not getting the benefits of the capital gains. The transactions of the secondary markets are generally done through by the medium of exchange, means either from the stock markets or either in the bond markets. The main purpose of the secondary markets to create liquidity in the security. Liquidity in the security means that any times if you wanna buy or if you wanna sold out, so investors are free hand that they can buy the security and sold outing it, again buying and sold outing of the different corporations securities. So secondary market in general is that a market where already issued securities are trading. That market is called secondary markets. Features of the secondary markets. So secondary markets comes after the primary markets. This is first one feature. Second one, in this markets already issued securities that are trading. Then it provides liquidity to the security, means any time if any person wants to sold out their securities, they can sold out. If they buy, so they can buy. And another one features that the secondary markets that encourage the new investors. If new investor want to make investment, so they make investments in the secondary markets. They already buy the issued securities at lower prices, and when their prices are increasing, so they sold out in such a markets those security by gaining the profit in shape of capital gain. So this was the explanation regarding to the primary and secondary markets. Inshallah, in the next class we will discuss our next topics. So till then, Allah Hafiz. If you have any questions, so ask in the group.